Well, welcome everyone to Women on Wealth. And today we're going to talk about fundamental concepts of investing in today's market. And I hear very often from individuals that want to be successful investors, and yet they don't take the time to learn some of these basic concepts that we're going to hopefully drive home today. And so to help me in this conversation, I have Karen Dolan, who is head of marketing at Dimensional Fund Advisors. If you're not familiar with them, they are an investment management firm with over 40 years of investing experience, and they are today managing about $540 billion in assets. And beyond investing, they do help support the financial professionals in a shared mission, to deliver a successful investment experience to our clients. So that's why I'm thrilled to have Karen here today. Really quick background, she is a chartered financial analyst. She's been at Dimensional for about 10 years. And prior to that, she was director of fund analysis at Morningstar, which is a very popular research firm in our industry. And she also has her MBA from the University of Chicago Booth School of Business and her BA from the University of Michigan. So we have a tremendous amount of knowledge with us here today. So thank you, first of all, for joining us, Karen.
Thank you for having me, Julina. Nice to be here.
Yeah, and so I think this is an incredibly important topic, especially given where we are in the markets. We are recording this in the end of 2023. At one point, the markets are moving around.
2022. Hey,
I'm sorry, 2022. I was just doing my planning for 23. Thank you for correcting me.
Hey, I'm in the same boat.
I hope we're not quoting the same market return for 2023, but in 2022, the equity markets dropped at some point around 25%. The bond market simultaneously fell around 15%. Obviously, that has investors worried, and I think this is a really important time to talk about these fundamentals. So welcome. And I think on that note, I'm going to add, I'm going to have you drive this conversation, but you and I were talking a lot about having uncertain times like this. I experience clients that come in, a lot of times they're women who have lost a spouse, are divorced, and they are emotionally uncertain, but then on top of it, they have to put their financial planning in place. So I guess if we can start there and talk about the uncertainty.
I think it's a great place to start because being a good investor, I think, requires some level of learning to deal with uncertainty, just like in life, actually. And one of the things that I always say to people, friends, folks who are not in this field, who are like, I don't know what I don't know. I find it very scary. I'm not sure how to even approach the topic. I actually think that there are certain life aspects in your life, things that you encounter every day, whether you're in this field or not, that may make you a better investor than you think you are. And one of those topics is uncertainty. Uncertainty, clearly, we face it every day. I don't know, what we're going to have for dinner tonight. Like, that's a very different form of uncertainty. And there's big uncertainty that people face in their life, their career, their children, their health, their families, their friends, their lifestyle, all of these things we face and encounter. And one of the interesting things about uncertainty, because you face it in life and you also face it in investing, is while it can create a lot of stress and a lot of anxiety, and I think we all, fall into that, it also creates a tremendous amount of opportunity. And just think about, life would be pretty dull if everything were sort of pre-decided, known in advance, and that was it. And so I think when you consider how you apply that concept of uncertainty to investing, you have to bear some uncertainty. Otherwise, there's no return. There's no positive. You'll get the risk-free rate if you're not taking on any uncertainty. And so I think while both in life and in investing, it can create stress, anxiety, and that's normal, I also think it's, behooves us to really think about the opportunity that it can open up and learn to deal with it. Learn, what's in your control, what's not. Have you taken the right level of risk? And that's why I think working with firms like yours and in your field, it's just so important to have a trusted financial advisor that you can work through those topics with.
Yeah. Thank you for saying that. And you mentioned the risk-free rate. Can you talk a little bit about that? Because I know a lot of times individuals that when they are uncertain and they're nervous about the markets, the reaction is, I'm just going to play it safe. I'm just going to park in cash. And there also is some danger in that too, in terms of doing that for the long term. Can you talk a little bit about that?
Yeah, absolutely. I mean, the instinct can be put it under the mattress, put it in a savings account, have it safe and secure. And for some level of assets, and this is where I think you advise people on what's the right level to sort of park. But think about the inflation we faced this year. If you have your cash just sitting there and not working for you, you've already lost 7, 8, 9, whatever percentage you've lost in purchasing power. And if you have time, right, if you're looking at a 5, 10, 15, 20-year horizon, you are leaving a lot of opportunity on the table if you have more than you need in cash. And so I think it's really, unfortunately, there's no even risk, even having it parked bears other risk, which is losing purchasing power over time.
Yeah, absolutely. And, you also mentioned time, which I automatically think, especially for business owners, they always put their business first, and they rarely put themselves first. And they think about retirement much later on, which can be a dangerous plan in terms of not having time on your side. If maybe you can talk a little bit about that. I spend a lot of time talking to business professionals about making sure that they're planning for their retirement, not just for the success of their business.
Yeah, and I think it's so important. I mean, this is the power of compounding. You have two great friends in investing, and it's the power of compounding and the, diversification. We like to say diversification is your buddy. I think Nobel laureate Merton Miller first said that, and we continue to say it because it's true. And so, I think that for anybody who has a long-term time horizon, I mean, it's the rule of 72, right? So if markets go up 10% a year annualized, and they don't typically do that in any one year. But if that's kind of the historical rate, and it's been roughly the historical rate for US equities, you're doubling your money in 7 years' time. And that is real money, and that is real compounding at work. And similar to how we talked about uncertainty, that's something that you have in life. And it's also something that applies to investing. I think that power of compounding, the little decisions you make, if you're a business owner, and the example you just shared, all the things you did to build that business, to invest in that business, to improve that business, the choices made, the experiences had, the lessons learned, just like in investing time, to accumulate this power of kind of compounding. I think in life you do as well. And you want to sort of carry some of those lessons over from the investing world back into life. If you have everything riding on your business, there's some diversification challenge there as well. There's risk that you're taking that you might not understand you're taking, or know, or fully realize that you're taking. So I think that these lessons around diversification, compounding, and trying to keep it all in balance through your situation. And again, I think this is what you all do so well. If you understand the concepts, and if you have, time on your side, and you have the discipline to stick with it, these are really powerful concepts. You mentioned performance this year, right? It's been an awful year in markets pretty much across the board. Yeah. But I was looking recently, and if we were to just rewind 3 years ago, we're sitting here, it's December of 2019. And let's just say that I had like perfect foresight to say, here's what's going to happen in the next 3 years. We are going to have a global pandemic hit, and basically the world's going to screech to a halt, and life as we knew it is going to look very, very different for a period of time. Unemployment rate spikes, it drops back down. You have, markets, obviously there's a lot of volatility in that period. In terms of who the winners are, who the losers are. Remember everybody buying Pelotons, Netflix, the FANG stocks, Facebook, Apple, Netflix. And so I think the concept of like, if I told you all of that was going to happen, and then it would be followed by, the election cycle, the whole political cycle we've had, as well as inflation at rates we haven't seen since the 1970s. And we're, again, December 2019, would you invest in equities?
I know, talk about uncertainty.
I mean, we didn't even know those things were going to happen, but knowing all those things were going to happen, if you had perfect foresight, would you invest in equities?
I think that that's a really would be very worried. Yeah.
They would be worried. And what has the stock market done in that time period? I was just looking actually.
Yeah.
So starting December 1st, 2019, through the end of November, just a week ago, if you take the Russell 3000 index, which is 3,000 US companies, so basically good full market, all market exposure to US equities,
Sure.
the return over the last 3 years has been 10.28% annualized.
It's amazing.
And all of those things happened.
Yeah.
And so I do think this instinct, the fear, I mean, markets have a way. Now, there were a lot of winners, there were losers, there were a lot of ups and downs. You had to be in it in order to get that full benefit of that return. But the market does have a way of sorting that out, and prices adapt to new information, and that diversification, right? 3,000 companies is in there. And I think that it's just a really interesting, reflection to look back.
No, that's a great point. I appreciate you mentioning that, because I think it's another example of just time being on your side. There are a lot of investors that look at their portfolios on a daily basis, and we have that technology at our fingertips, which is a blessing, but can also be very challenging, because it creates these emotions on a daily basis. But when you look over a longer period of time, right, you get these returns despite all of this uncertainty that we're seeing in the markets. So that's a great point.
And I think it really comes down to, like, how do you have a plan that accounts for a range of outcomes, because anybody's prediction is anybody's prediction. So you really need to have a plan
Yes.
that accounts for that range, that full range. And then, how do you tune out the noise and create a plan that's going to work for you and stick with the plan. And that is easier said than done, certainly. But
Sure.
I think if you look at just kind of markets over time, and every time it feels different, but it's a really interesting, I think, kind of lesson in some of these fundamentals around power of compounding, power of diversification, putting time on your side, tuning out the noise. Very difficult to do, but certainly, I think, a good foundation to build on.
And let's talk, if we can talk about diversification just for a second, because, this is one of the fundamentals that we are all taught, and we love to tell our clients, you own stocks and bonds for different, because they perform in different timeframes. And unfortunately, that did not happen this year. And so it's never perfect, but can you talk about the importance of maybe diversification over the longer period of time versus just 2022?
Right. I mean, I think, and there have been many studies on this, just the power of diversification. There's like arithmetic behind it as well, in terms of how different assets and their correlations. And it doesn't always work out like a certain way, right? If everything was fully predictable, there again, you wouldn't be being paid for that uncertainty. But I think, having a well-balanced portfolio that has, US companies, international companies, small caps, large caps, value, growth, fixed income, and making those decisions around risk and return, and how you balance a portfolio and keep a portfolio balance, because things can shift over time. That has, I know people will pick a small period, an outlier, but I think that over time is better than the alternative, which is trying to time those things. And there's just no compelling evidence that you can time those things. Because you not only have to figure out when to sort of increase this and decrease that, but then you have to figure out when to increase it or decrease it the other way. And so the alternative to this, well-balanced, diversified approach is also a very difficult one, and one that just simply doesn't have empirical support behind it.
Right. And you mentioned some of the studies. One of the interesting studies that I've seen on diversification, if you can maybe elaborate a little bit on it, is how important the diversification piece is relative to the return that an investor gets over time versus maybe picking that individual stock or bond. We get that a lot in these markets where, a client called me the other day and was like, what do you think about Disney? It looks like it's on sale. I'm like, well, there's a lot on sale. Right. But, and that's great that she paid attention and she's looking at these, buying opportunities, but the diversification piece is probably one of the more powerful pieces of the investing in the long term. If that's fair.
Absolutely. I think that is the key lesson. The other point that I think about when you raise that example is just how markets work. So if you take the example you just shared of a specific company, there are buyers and sellers every day, every moment of the trading hour that are, basically duking it out in markets. The seller, the price needs to be, high enough to compel the seller to give up the shares and low enough for the buyer to think that they're going to have a good expected return.
Right.
And they have different expectations, clearly, and that's okay, but in the end, all of this activity, and that's why the markets, I think, and all of the volume that flows through markets, we like to think of them as an information processing machine.
Yep.
So, when I have this conversation with my dad, who also likes to, and, talk about things this way and think about it that way, I'm like, what insight do you have that's not already priced in? It's not that you don't have an insight. I'm sure your insight might be valid and valid to you, but has it been baked and into the price? And
Right.
My view is it has. And I think that's why we've seen markets sort through all of the uncertainty, not just this, recent stretch, but always. It's because people are in there and they're reacting quickly to new information and changing expectations.
Yeah, absolutely. I think that that's a great point. And can you talk a little bit about rebalancing? Because I noticed going into the pandemic, when things looked fantastic and the markets kept going and going and going, that a lot of investors were not rebalancing their portfolio. Can you talk a little bit about what that means and the importance of it?
Yeah, I think that, and this is where, I'd love to hear from you as well, because I think that you, in the wealth space have done just such a phenomenal job creating programs for your clients to systematically adjust as things move away from what your sort of original target was. And, if you look at a period like March of 2020, that was the period of time when small cap value equities in general were really, they were at their I think it was like the worst 3-year period that we've ever seen in their history. Now,
Right.
We're not saying go make a market timing move based on that information, but if you have a certain proportion of your portfolio, that would have actually been a phenomenal time to rebalance back to the weights that you had intended, and it would have paid off for you very handsomely. But if you think back, that in that time period, in that moment, I think people were not talking about rebalancing. They were talking about what's going to happen and all the uncertainty. And there were a lot of people selling out altogether. There were a lot of people trying to buy the companies that seemed to be the clear and early winners. The FANG stocks, many of which have, if you look at what's happened to many of those stocks since then, they rose and then they've quickly taken a fall. And I think, again, we can't predict exactly how that's going to look, but a more systematic approach where you're saying this is the profile that is right and this is the risk profile and I'm comfortable living within a range of outcomes, and we should continue to sort of move back into that would have served people very well in that time period.
Yeah, absolutely. I noticed a lot of clients or prospects, I guess we should say, because we were rebalancing, but clients that should have been 60% stocks and 40% bonds that just sort of let it grow. And then all of a sudden it's 70% stocks and 30% bonds. And so when the market took a hit, unfortunately they took a bigger hit because they didn't rebalance. And I think that's a hard topic because it means that you're taking from the really successful part of your portfolio and moving it to the part that didn't do as well, which is a very emotional, I think, process to undertake.
I think the word emotional is a really interesting one because I think a lot of people feel you have to ride that roller coaster if you're going to play in markets. But I don't think you do. You can actually, invest in a broadly diversified portfolio at with an asset mix that you've worked on with your, financial advisor, and not have to feel like I need to make a decision because you've already worked on a really good, solid plan. And then the hard part is sticking with that plan. And not making a decision is making a decision, actually. And so I think that, trying to resist the urge to make decisions that have a lot of emotion attached. If anything, it's better to ask yourself those questions before those things happen. You may not know what's going to make the market go down by 30, 40, 50%, but it's happened. And what would happen if it were to happen again?
Yeah, absolutely.
Right. And so
Absolutely.
it's it's great to ask yourself those questions when you're not in the heat of, and the
Yeah.
same goes on the other side, because this is not just a fear thing, it's also a greed thing. When things are, flying high and there's just free money over here, everybody's doing this, or a little bit of, either YOLO, FOMO, whatever you want to use. And I think we saw that with crypto. We've seen that with a lot of, shiny objects where you feel like you have to get onto this new shiny thing. There's no kind of magic bullet or silver bullet. And I think that there's just a lot, both on the fear side to avoid the emotion, but also on the greed side to be careful around, ask some basic questions on where do the returns come from? What is the risk return profile? What have been the historical range of outcomes? And how long of a history does it have that enable you to think through, is this an investment that I can understand and that I could, that fits in terms of risk return profile and that I can stick with? Because having a philosophy and approach you can stick with is probably one of the most important things you can do.
Absolutely. Absolutely. And do you have any tips or can you make any comments about how to be a successful investor for the long term outside of, we talked about time and the power of compounding and diversification, but what are we missing here?
Well, I think there's so much it's just focus on what you can control. How early you start, how soon you start. I was really fortunate in that I came into this industry, two great firms, Morningstar first and now Dimensional, who have just taught me so much about investing and helped me take my emotion out of it. And so I started early and it hasn't been so hard, actually. When you have, so that would be advice number one, whether, you're just starting out in your 20s or you're the small business owner that you were reflecting on, and you may be a little bit later in your career. It's never too late. And so just getting started, I think, is big step one. And then from there, trying to develop the habits, I think. What are some of those small habits you can stick to over time so that you're, whether it's the savings rate that you want to contribute to, whether it's, the plan, and then, making sure that your plan is something that you're able to stick with in good times and bad. Like, these are things that are all in your control. I think trying to find a way to live as an investor rather than live as a worried investor. And that's easier said than done as well. But I think having, some of these kind of core concepts and reminding yourself of them, and it requires tuning out a lot of noise. And that can be hard. There's everywhere you look, Super Bowl this past year, I think every other commercial that I saw at least was a crypto commercial. Turning on the TV, the top 10 stocks to buy, the this, the that. Like, I think that those, I really kind of taking some of that with a grain of salt. Is it entertainment? What are the incentives of the people putting it forward? And, how do I make sure that I understand what this investment really is and how it fits into my plan?
Yeah, I think your point about habits is so important. Very similar to you, my first firm I worked at right out of college, the head of our business made me fill out an application. There was no human resources back then, and made me start putting money every month into a few different mutual funds, dollar cost averaging, right? And he trained the habit of, even if it was just $25 a month, create that habit. And as I got older, I was able to increase it. And it created a fantastic habit. And then he came back to me a year later and said, all right, we're gonna move this around, and this that did really well, we're gonna move some here. He taught me the concept of rebalancing. And I remember thinking, why on earth is he having me sell a little bit out of this one that did so well into this one? And that was another important, I wish that we could, I wish we could impose this on everyone right when they're out of college, but maybe we'll get there someday.
I hope so.
Yeah.
I certainly hope so.
Yeah. And I think, funny enough, in the pandemic, one of the books that I read was, I've got it right over here on my bookshelf, Atomic Habits by James Clear. And it was it's the same exact
I've
concept.
heard about it though. Yeah.
Yeah. Just tiny little tweaks every day can really make big changes in habits. And I think this is exactly what we're talking about. So you made a great point, and I think we're hitting on this now, Karen, where you were talking a lot about, taking day-to-day experiences and bringing that into the investment experience. And I think that that's just another example of that. So
I agree. Absolutely. Right. Like your habits in your day to day, your choice to get a little more physical activity. And these are things that are hard to do if you make them too big. And I think investing also can be broken down into some small parts and can be done well. And you can live with it in a way that doesn't hopefully give you that the stress and anxiety side of the uncertainty, but more of the reward side of it.
No, absolutely. And we started the conversation talking about all this uncertainty. And maybe we can sort of transition and come to the end of the conversation talking about reasons for optimism and talk a little bit about why investing in the markets long term is actually a positive thing.
Yeah, this is my view. I think sometimes people look at me funny if it's like, why be optimistic as an investor? There's just so much to worry about. And when I think about it, for me, investing in the market, I know can seem like this abstract, amorphous thing that exists on Wall Street or wherever it exists and scary. And what is that? Well, really, what is it really is it's a collection of publicly traded companies. They are companies that many of which we've heard of, some of which we've not, but they're all providing products and services into the world. And the markets are a mechanism of providing capital to those companies. Those companies are, I mentioned the 3,000 US companies earlier. They have employed millions, tens of millions, hundreds of millions of people. And those people are going to work every day trying to, better their own situation, provide for themselves and their families and the causes and things they care about. And so, I actually view markets as that. And there's so much human ingenuity that is filtering through that market mechanism every day. And I don't need to know who the winners are, who the losers are. But we basically have this huge collection of people working to provide goods, services, and add value and compete. And they won't all win. But I think that what the market does is it provides capital and it processes a lot of information. And so you can participate in the net result. And if you think about all the innovations that we've seen, not only, in the last 3 years, how companies adapted. They don't just sit still and say, I'm going to just take it. They adapt, they get creative. And that's people on the ground who are making that happen at every level of a firm. We were actually, if you think back 20 years, like to what the world was like 20, 25 years ago, my daughters and I just watched Notting Hill this past weekend.
Oh.
And that came out in 1999. And I only bring it up because they were on phones with like little squiggly cords. And there was, Hugh Grant had the bookstore that had all the travel books. And I was explaining that to my daughters. I'm like, travel books, like I remember those, but you do all of that work online now. And so that's just an example of the human ingenuity that I think markets enable you to participate in. And I think that's a pretty cool thing. So why am I optimistic? Because I really think that people who are doing that work every day are going to continue to adapt and be creative and innovate, and they won't all win. But I think that the market captures that value and provides capital for that value to continue. And I have faith in that at the end of the day. I really do.
I completely agree with you. And I think it's also an important note that when you look at it, the economy and what drives our economy, we are a consumer-driven economy. So if that's the case, then I think your point is very valid. So, do you have any insight for investors thinking about, these fundamental concepts on where they can either learn more or how they can, how they can maybe put this into practice? I have a couple of ideas, but I'd love to get your thoughts.
Yeah, I think, you want to find trusted sources and also just try to, divvy up the world between those who are really providing entertainment and maybe trying to get more of a click than they are helping you. And so I think people are in the best position to determine for themselves what that is. I know that in our content, for example, it's all educational and we work predominantly only with professionals. So we don't work directly with individuals, but we provide a tremendous amount of resources because it's important to us that the professionals we're working with and the individuals and the investors that they serve have, a good investment experience. And you need more than a product, an ETF or a mutual fund to have a good investment experience. So we provide a tremendous amount of content publicly as well as through the professionals we work with. to try to help, try to help people make sense of all this volatility, try to make people make sense of, what it really means for their investments. And so we try, but I'm sure you also have. I'd love to hear what's on your list.
No, I agree. I'm thinking, for example, I've got an 11 and 13-year-old, and right now everything that they're listening to is coming from TikTok, right? And so we spend a lot of time talking about understanding, who is the source and how valid is the source. So I think your point is an important one about getting the information from social media or from the internet in a way that's logical. And, I still think that having one-on-one relationships with a professional that you can trust is also important, but I'm a little bit biased. So
I agree. I do. It's funny. I have two daughters as well, ages 11 and 14, and we've trying to, practice on them a little bit, like having this conversation about investing and like, how do you really break it down? One of the things, and I wish there were more out there on this, but like, it's too bad that a lot of our young people learn about investing through these like stock challenges. Right. I mean, that's a bummer because that's not necessarily, it may be fun and engaging, but it's not necessarily hitting on some of the principles that we've just covered here today. So maybe someday we can change that.
Yeah, I struggle with that one too. I know a lot of adults that got into finance and got into the business because they were introduced at an early age to something like that, which I think is fantastic to engage them early into the notion of investing in finance. But to your point, all of these fundamentals are more important in the long term than finding that one stock. So finding a balance between the two, it's something I agree with you. I'm talking about that a lot with my girls. I don't have the right answer. It's difficult to get their attention on something. Maybe I should form my own TikTok and maybe they'll listen to me. I don't know.
Yeah, I will definitely watch it.
Yeah, I'm sure my compliance officer would love that. I think at least having an awareness of it is the first step. Yeah,
agreed.
I appreciate that, Karen. Any last thoughts on what we might have missed in the conversation that you think we should address?
I think we covered a lot of ground. I would just end it by saying that, we have the pleasure of working with a lot of people like you who are really trying to get out there and educate. I've seen the wealth industry shift from more, call it just asset allocation based. We've all seen this, to much more educational, much more of a coach, much more kind of financial life and wellness oriented. And I think that is such a phenomenal shift, and one that I think is going to be really critical to helping more people with this topic down the line.
I agree. I'm fortunate to be part of a firm that's very that focuses on the education to our clients. I also have seen that, and I hope we continue. I hope we continue to do that going forward. Your firm has been fantastic with the resources to professionals, so thank you. It's been a tremendous resource that we can use with clients and that we have. So we appreciate that.
That's great to hear. We love providing it.
Great. Well, thanks, Karen.